to master your money, you need to understand the rules. The world of finance can seem complicated, but at its core, it's about knowing who sets the rules and how those rules affect your daily life. The Federal Reserve, or the Fed, is the main bank for other banks, not for individuals. Think of it as the backbone of the U.S. financial system, quietly working behind the scenes to keep everything running smoothly. Its job? Keep the economy stable by balancing two goals: controlling inflation and supporting maximum employment. These goals are crucial because they impact everything from the price of groceries to your ability to find a job. The Fed is like a ship's captain, steering the economy using powerful tools, most importantly, interest rates. By adjusting these rates, the Fed can help guide the economy through calm waters or stormy seas. Interest rates are simply the cost of borrowing money. They determine how much extra you pay when you take out a loan or how much you earn when you save. When you borrow for a car or house, you pay interest. When you save, the bank pays you interest. These rates affect your monthly payments, your ability to save, and even your long-term financial goals. The key rate is the federal funds rate, the rate banks charge each other overnight. This might sound distant, but it's the foundation for all other interest rates in the economy. This rate influences everything from your mortgage to your credit card. When it changes, the effects ripple out to nearly every financial decision you make. When inflation is high, the Fed raises rates to slow borrowing and spending, cooling the economy. This helps keep prices from rising too quickly and protects the value of your money. When the economy needs a boost, the Fed lowers rates, making borrowing cheaper and encouraging spending and investment. This can help businesses grow and create more jobs. Every Fed rate change ripples through the financial system and affects your wallet. Even small adjustments can mean big changes for your savings, loans, and investments. Understanding this relationship is the first step to making smart money decisions. The more you know, the better you can plan for your future and protect your financial well-being. You don't need to be a Wall Street expert, just an informed participant in your own financial life. Staying aware of how the Fed's actions affect you can help you make choices that work in your favor. The Fed's decisions shape your ability to buy a home, start a business, and save for retirement. By understanding these forces, you empower yourself to take control of your financial journey. It's September 18th, 2025, a date that's been circled on calendars across Wall Street and Main Street alike. Today, all eyes are on the Federal Reserve, the central bank whose decisions ripple through the entire economy. After months, some would say years, of keeping interest rates high to battle stubborn inflation, the Fed is widely expected to announce its first rate cut in a long time, marking a major shift in policy. Most experts predict the cut will be modest, likely around 0.25%, but even a small move can have a big impact on markets and borrowing costs. So why now? Inflation, which was once a major threat to the economy, has finally cooled off and is now hovering close to the Fed's 2% target, a level considered healthy for growth. With inflation under control, the Fed can shift its focus back to supporting jobs, encouraging business investment, and helping the economy expand. High rates have slowed the economy, making it harder for people to borrow, buy homes, or grow their businesses. But if the slowdown goes too far, it risks tipping the country into a recession, leading to job losses and business struggles. A rate cut is the Fed's way of aiming for a soft landing, lowering inflation without causing a painful downturn, and trying to keep the recovery on track. This move signals a new chapter for the economy. The Fed believes the worst of the inflation fight is over, and now it's time to nurture growth and restore confidence. The Fed isn't just reacting to today's numbers, it's looking ahead, planning for the next year and beyond, trying to balance risks and opportunities. For everyone, investors, businesses, and families, this shift could unlock new opportunities, from lower loan rates to renewed optimism for the future. The Federal Reserve's decisions hinge on two crucial factors: inflation and jobs. These two pillars guide every move the Fed makes, shaping the direction of the entire U.S. economy. For several years, inflation was the main concern. Prices for everyday goods and services soared, squeezing household budgets. To fight this, the Fed raised interest rates aggressively, hoping to cool things down and bring stability back to the market. Now, after months of effort, inflation has dropped much closer to the Fed's 2% target. This signals that the worst of the crisis has eased, and the relentless price increases are finally slowing. While some inflation lingers, the overall trend is clear. The fever has broken and the economy is regaining its balance. With inflation largely tamed, the Fed can now shift its focus towards supporting economic growth and making sure the recovery continues. But there's a new challenge. The job market is showing signs of weakness. Unemployment is ticking up, and wage growth is slowing, making it harder for families to keep up. Some months even show job losses, raising concerns about the strength of the recovery and the security of American workers. When people worry about their jobs, they tend to spend less, which can slow the entire economy. Consumer confidence drops and businesses feel the pinch. The Fed's dual mandate means it must support both stable prices and strong employment. Balancing these goals is never easy, especially in uncertain times. A softening labor market is a warning sign that the economy may need help before things get worse. By cutting rates, the Fed makes it cheaper for businesses to borrow money, invest, and hire new workers. This aims to prevent a small problem from snowballing into a bigger crisis. The combination of cooling inflation and a weakening job market is exactly why the Fed is preparing to pivot its policy, shifting from fighting inflation to supporting growth. It's a proactive move designed to keep the economy on track, ensuring that progress isn't derailed and that Americans can look forward to a more stable future. A Fed rate cut isn't just for Wall Street, it affects everyone. Lower rates mean cheaper loans for homes, cars, and personal needs, making big purchases more affordable. If you have variable rate debt like credit cards, your interest charges may drop, freeing up cash in your budget. That extra money can help you pay down debt, save, or cover rising costs. Small businesses benefit too. Cheaper loans mean more hiring, expansion, and investment. More business activity creates jobs, which leads to more spending and a stronger economy. It's a virtuous cycle. Lower rates boost borrowing, spending, and growth. The Fed's decisions in Washington ripple out to Main Street. A rate cut is designed to give the economy a shot in the arm. Ultimately, it's about making life a little easier for families and businesses. Lower borrowing costs don't just help individuals, they can supercharge certain parts of the stock market. Real estate is a big winner. Lower mortgage rates make homes more affordable, boosting demand for builders, suppliers, and home improvement stores. Real estate investment trusts, REITs, also benefit, since they rely on debt to buy properties and must pay out most of their income as dividends. When rates fall, REITs' borrowing costs drop, potentially increasing profits and dividends. Small cap stocks, shares of smaller companies, often rely on loans to grow. High rates can hold them back, but lower rates make it easier to expand and compete. These sectors can become more attractive to investors when rates drop. Understanding which areas benefit helps you see how money moves through the economy. Rate cuts can create new opportunities in real estate, REITs, and small cap stocks. Let's make this real with a few examples. Remember, this isn't investment advice. Vici Properties Vici is a REIT that owns famous casinos and resorts. Lower rates help it refinance debt and fund new acquisitions, boosting profits. Equix is a data center REIT powering the internet and cloud. As demand for data grows, lower borrowing costs help it expand. Both Vici and Equinix show how REITs can benefit from falling rates. For small cap exposure, consider an ETF like iShares Core S and P Small Cap ETF, IJR. Instead of picking individual small companies, an ETF gives you a basket of hundreds spreading out risk. Small companies often benefit most from cheaper borrowing, fueling their growth. These examples show how rate cuts can impact real businesses and investment options. Always do your own research before investing. Understanding these connections helps you make smarter choices. Big economic news can make you feel like you need to act fast, but don't panic. The best investors avoid emotional decisions and stick to a long-term plan. Trying to time the market rarely works, even for the pros. Use moments like this to review and rebalance your portfolio, sell a bit of what's grown too much, buy what's lagged, and get back to your target mix. Consider where new investment dollars go. Lower rates can create tailwinds for real estate, REITs, and small caps. Make small, thoughtful adjustments, not drastic moves. If you have cash in high-yield savings, remember those rates will drop as the Fed cuts. Think about whether some of that cash could work harder in long-term investments. The key: have a plan, know your goals, and make decisions based on logic, not headlines. Stay disciplined and focused on your financial future. Everything here is for education, not financial advice. Your financial decisions are your responsibility, and your future is too important to base on a single video. Always do your own research before investing in any company or fund. Read reports, understand business models, and know what you're buying. Never invest in something you don't understand. If you're unsure, seek help from a qualified fiduciary financial advisor. A good advisor teaches and guides, not just sells products. Keep learning. Read, listen, and ask questions. The more you know, the more confident you'll be in navigating the financial world. Wealth is built steadily, not overnight. Education is always the first step. The Fed's new cycle of rate cuts marks a hopeful shift, moving from fighting inflation to supporting growth. For you, this is a starting point, not a finish line. Use your knowledge to make smart, patient decisions. Understanding how rates affect everything from your mortgage to the stock market puts you in control. Don't be intimidated. Personal finance is about simple truths. Spend less than you earn, save, invest, avoid high-interest debt, and protect your family. These principles work in any economic climate. Your steady actions over time matter more than any single Fed decision. Look ahead with confidence. You can make smart choices for your future. Review your plan, deepen your knowledge, and stay committed to your goals. The world of money isn't a secret club. You can learn to navigate it. By taking control, you're building not just wealth, but freedom and security.